Hello, everyone, and welcome to Creative Financing 101. This is a class that I have taught on and off over the years, but this is entirely new content because, quite frankly, the last time I was teaching this class was when the market was in a totally different place. And I've taught it a few times for a few different reasons over the years, but this is a completely new set of slides, and I'm excited about them because these are questions that I get in different scenarios, different areas. But there's some pluses and minuses to creative financing. So we're going to dive right in, and we're going to have a very transparent conversation of why it's nice to have this in your toolbox, but I'm going to ask you to put it in the back of your toolbox. So let's dive right in. Creative Financing 101, but mortgage is not an option. Let's start off by getting a history of creative financing. Before we go anywhere else, I always like to say, here's why we're even talking about this. So this first became common during the wild interest rate hikes of the early to mid-1980s. Now, this was before a lot of us were practicing real estate, maybe before some of us were even born. I was born, but obviously not practicing real estate at that time. But you always hear from some people that have been in the industry a lot longer than some of us that, oh, my gosh, interest rates were 18.5%. Nobody wanted to buy. The banks were lending, but they were lending these astronomical interest rates when inflation was crazy and interest rates were very, very high, and it just made it impossible to buy. Affordability was a massive issue because obviously the higher the interest rate, the less you can afford. And so that's when some private owners said, well, maybe there's something else we can do. Maybe we can act as a bank. Maybe we can create some sort of contract or creative type of financing bridge until this situation changes. It's also always been a favorite of buyers since then in economically challenged times. So if you have a situation where banks have stopped lending, you saw a little spike in this type of conversation after the real estate market crashed or as the banking system collapsed in the great crash of 2008, 2009. When banks become restrictive on lending, this all of a sudden comes into vogue again. It's also potentially attractive for sellers of really hard to finance properties. If they've got a property that's a mess, if they've got a property that is, just something that is not attractive to the traditional buyer, it's not going to be attractive maybe to some banks due to condition, et cetera, then this may be a property that a seller decides to sell with creative financing. Some entrepreneurs with hard to pin down income, they like this too because they're not seen as a good risk by lenders. Maybe it's somebody on 1099 income that's new to 1099 income and doesn't have a long track record with it. Someone that started a business, maybe they used to make a lot of money or they still make a lot of money, but it's business income and you've got to go show 2 years tax returns or more and you just don't have that yet. This is another option for them, at least on a temporary basis. So with all of this being said, that's the history of creative financing. Here are some drawbacks to it. And this is why I kind of hesitated to teach this class when I've had some requests for it, because I feel like it opens a little bit of a Pandora's box. And here's why. Number one, buyers, watch out for creative financing because the sellers are much, much less negotiable in many situations on their purchase price because they are essentially not getting their money out of the property right now. Most sellers want to sell. They don't want to be stuck with their property. Otherwise, they'd rent it out. So your buyer, for those of you guys that are realtors watching this, your buyer is going to pay most likely a large premium for the property. This is not going to be the deal of the century because they're also getting creative financing. So you really got to pick and say, okay, do you want a great price or do you want these special terms? Most people are going to want the best price. That doesn't happen most of the time with creative financing. So buyers, watch out. You may be paying a premium for the property for the luxury of having creative financing on it. For sellers, and this is why sellers are asking a premium or demanding a premium on their property, you're not getting your cash out on the property yet. So in other words, at a traditional closing, the buyer comes in, they've either got cash or in most cases a mortgage. That's essentially an invisible pile of money comes in the closing room. The seller goes, great, you wanted my property for $400,000. I get my $400,000 minus my closing costs and whatever I owed on the property. I'm getting out of this property. I'm cashing out and I'm out of here. That doesn't happen with creative financing. The seller doesn't get to cash out because they're not getting all their money right now. They still have the liability of the property because they still own the property. They technically still have legal title, even though these creative financing quote-unquote buyers have some sort of right there. The seller may even still have to foreclose on the property should the buyer default. So think about that. If you've ever been a landlord and a tenant stops paying, you've had to get that tenant out. That is tough to do in a lot of cases, especially depending on what jurisdiction you're in. Some jurisdictions are very tenant-friendly versus landlord-friendly. It is even harder to foreclose on a property, particularly if you are a traditional seller versus a bank. It's just a tough thing to do. So sellers are charging a buyer a premium purchase price-wise because the sellers aren't getting fully out of this property. They are still having some sort of ownership, interest, and liability for this property when they're doing creative financing. For realtors, if you're advertising creative financing either on your listing or as an option for buyers, or you're saying, hey, I've got some options for you besides a traditional mortgage, you may open that Pandora's box and pigeonhole yourself into a large number of conversations on credit repair, conversations with people that just may not be in a position yet to buy a property. So there are some situations where a buyer should simply work on their credit, work on saving money, and get a traditional mortgage, a lot of cases. But these are the drawbacks here to consider. And then let's talk about the actual benefits of creative financing. So I told you about the drawbacks, kind of scared everybody off, buyers, sellers, and realtors. But why are we here? So there is some good to creative financing. Number one, it is a solution for people with low credit scores or lack of down payment. So again, not everybody's ready to buy. Not everybody should buy right now. But there are some people that are, working themselves out of a bankruptcy. They've got something on their credit that will come off at some point, but they want to lock that property in now. Or quite simply, I've had people that are just starting to do very well, or they have a large settlement coming in the near future. Maybe it's someone passed away, they've been willed some money, they have an insurance settlement, something like that. They've got money coming. And in the meantime, they want to lock in a property now. What are their options? So it's a solution for those type of situations. It also, again, for your sellers, conversely, it can get you a premium price if you're having a tough time selling a property traditionally. You just can't get rid of a property. You've had it on the market traditionally. Nobody wants it. You could potentially get a buyer in the door that is willing to pay more or willing to buy a tough property that maybe nobody else has loved because you're offering creative financing. You're offering a buyer something, access to equity, access to potential future ownership, access to an ownership interest now by getting a premium price, by asking a premium price. So think about that as a seller. It, for the buyer, builds an equity position not otherwise available. And what I mean by that is if you can't qualify for a mortgage, how else are you going to build equity in a property? You can't unless you do creative financing. So again, for them, for your buyers, it could potentially build an equity position, locking in a price now, and yet they're going to be eventually getting appreciation. If the property is appreciating and they weren't able to buy that property otherwise, creative finance is the only way to lock in that price now before any appreciation hits. And we're going to talk in a second also about potentially maybe even getting a portion of your payments on this creative financing to act as a capital pay-in. So in other words, you're also paying down a potential note. We'll talk about that later. But building an equity position, that's an asset of creative financing. Then it allows those with an improving situation to work towards a goal early. So think about this. If you have someone that is in the credit repair process, but that light at the end of the tunnel may seem quite far out. If you get them into a property on a temporary basis, so in other words, a lease purchase, land contract, something like that, it gives them a real goal. They're already in the property. They're excited about it. They're going to be a lot more likely to fulfill their credit repair needs if they have a goal, or actually they're already in the home. The goal is stay in the home or keep this home and keep this potential equity and appreciation that they're building. So it allows those with an improving situation to work towards a goal earlier than if they're just say, well, once you get your credit repaired, we'll talk. No, talk now. That's the potential here. So what are the types of creative financing? Let's get into specific structures. There's contract for deed. That is land contract. This is the one that I think is most known, and especially you'll see this in some agriculture communities, some business communities. Contract for deed. It's one of the older ones. Then there's lease purchase. So that is when you are leasing it now, you're purchasing it later. Lease option. You're going to lease it. You're going to have a traditional lease. You're renting it, and you have the option to buy it later. And then there's a couple other ways too. Now these move from time to time, and how you're going to find any potential creative financing deals. Here's how you do it. You go add a field, sale terms, in the MLS. So in the MLS, you're going to add the field, sale terms. And that may be different if you're not in the MLS and I, where I coach mainly. So it may be something else, but in ours it is called sale terms. So you're going to add that field, and there's a couple other mentioned, but these are the big three. Any of these big three and anything else you can find in the MLS using sale terms. Lease purchases. So a lease purchase is going to allow you to rent and occupy the home now while having a contract to purchase the property for a set amount at a predetermined date in the future. So what that means, you've got the rent right now, you've got a document there. So you've got a lease, a rental agreement. Then you've got a second document, a purchase contract, a live purchase contract saying, I'm going to lease this for you now for, say, $1,500 a month. And then in 2 years from now, I'm going to buy it from you for $250,000 or whatever that is. So you've got a set lease now, and then you've got a set purchase agreement later. Price is determined. It is set in stone, and you've got the potential then to lock everything in right now. It is a definite. This is not an option. This is a purchase. So this is a lease now, purchase later, but you're signing both documents now. To do a lease purchase, all you've got to do, and again, we're in Chicago. We're doing a standard Chicago lease in a lot of areas. We're going to say an addendum like this. Tenant shall purchase the leased property, because you've already got the lease. Tenant shall purchase the leased property on or before blank for the purchase price of blank. So it's giving a date you've got to close by. It's giving you the purchase price. And then listen to this, security deposit. If you have a security deposit with that lease, it's at the security deposit given at the beginning of the lease term shall act as earnest money for this purchase and is not refundable should tenant fail to close on this property. So what that is that's giving the landlord a little incentive to lock in a price now, because guess what? If that tenant doesn't end up following through, so if they're in credit repair and they don't do their credit repair and can't get a loan, guess what? Doesn't matter. They're not getting their security deposit back because it turns into earnest money for that purchase. So it's a locked-in thing. If they change their mind, they find something else they like, guess what? That is no longer a security deposit. That is earnest money, and they're going to lose that earnest money. So this is a definite thing. This is locking in that security deposit. Is turning it into earnest money for the actual purchase. A lease option is a little less restrictive. A lease option, it's going to be similar. They lock in the price of the home. However, you don't have to actually go through with this. You can write a purchase agreement, or you can simply set a term of price, but you are not locked in to do so. So it's a very, very much less restrictive idea. It's saying, hey, I could do it, I don't have to do it, and then therefore there is no earnest money. Your security deposit, if you have one, that is simply a security deposit, and you're going to get that back based on whatever your lease terms are, unless you obviously have damages under the lease terms. But it doesn't turn into earnest money. It doesn't lock you in. So most of clients that we talk to, they want to do the option. It's less restrictive. However, for your sellers out there, your seller's going, well, wait, what possibly would that, why would I do that? I'm giving this person the option to do it, but what if they just change their mind? They see something else. A seller's probably going to want to lock into a lease purchase versus a lease option. But those are your two different scenarios as a lease. Lease now, buy later. Lease it now, lock in the price, buy it later. So to do a lease option, you're going to add the following to a standard Chicago lease, probably again as an addendum. Tenant has the right to purchase property on or before blank for the purchase price of blank. Election of the option shall be made in writing to the owner at the following address, aka notice, by blank. So they've got a deadline. they've got a right time to purchase, a price to purchase, and where to send notice to announce that they are going to go through with the purchase. And then, should tenant choose not to exercise these options, security deposits shall be refunded minus any damages. So there is the lease option. So, little caveat strategy for both lease purchase and options. Either one of them, you can negotiate out a dollar amount of each month's rent deducted off the purchase price. So what we mean by that is you're putting money, giving money to the landlord. In a traditional lease, that money is gone. That is the landlord's money. They're doing it, spending it however they want to. There is the philosophy, if you are among many people, that if you are going to lock in an agreement now for a purchase price, that you could potentially put yourself in an even better position if a portion of that rent every month was going to go towards the purchase price. Now, that doesn't mean the landlord has to put that in a special account or something like that. All that means is the landlord's going to agree to, hey, if you said you were going to close in 2 years, I'm going to then give you a credit against that purchase price of $200 or whatever the amount you've negotiated per month. That's going to be credited towards the purchase price. So it's kind of giving your tenant a reason, even more of a motivation to close, because now they've paid in all this money. They're going to get a credit. They've built in some, I don't want to say equity, but they've paid down a little bit on that purchase price to the landlord every month. So why not then go ahead and exercise that right? So for your sellers out there, why would they want to agree to something like this? Dollar amount going towards their purchase price every month, because that's really locking that tenant in a lot more likely to actually close, because they now have an incentive to close. And for your tenants, potentially your lease option or lease purchase clients, why would you not want to do this for them? Because obviously for them, that is helping them not just get the property under contract, but actually work towards that property, and portion of their rent going towards the actual price of the property. That's actually, you're building up their financial position. So think about adding that in. So the third type, beyond lease option, lease purchase, the one that a lot of us that have been in the business a long time have known the best, is the land contracts. It's also known as contract for deed. Some parts of the country, they may call it an installment contract. We see these in commercial real estate. We see this in businesses. We see this in all of the different situations, land contracts. So this is an agreement between the seller and the buyer for the purchase of real estate, in which there's a down payment to the seller. Now, so far we've not talked about down payments at all, because guess what? We're talking about leases, lease options, and lease purchases. Land contract, this is a contract to purchase, and there is a down payment, which, by the way, means that this land contract is being written up. You're probably talking at least 10% down, potentially 15 or 20% down. This is negotiable between the parties. Here's what I like as a realtor about a land contract or a contract for deed. Guess what? If they're putting all that money down, I'm probably going to be able to negotiate at least part of my commission being paid up front, because unlike a lease purchase or lease option, there is money down that's going to the seller. It's not refundable to the buyer. That's the down payment. You don't get a down payment back if you default. So you're going to do that initial down payment to the seller, and then payments monthly to the seller until the note between the buyer and seller matures. So what does that mean? You are basically, as a seller, you are acting as the bank. So in other words, you are selling the property to the buyer, and you are, quote unquote, financing the property for the buyer. You're acting as the bank. You are acting as the person, the bank, the institution, lending the money for the property. So you don't get rid of the property. You still own the property. We're going to talk about that in the last slide here. But you are going to, as the seller, this is not a lease. You don't have the lease signed. You are basically going under contract, saying this property, there's now an equitable interest by the buyer. The buyer is going to have possession of the property, and that I am going to finance the property for this buyer until the buyer pays off the note, which is obviously the land contract. That means that the buyer either has to pay this note off over the course of the term of it, whether that means they just pay the installment payments every month for the 30 years or 20 years or 10 years that you've negotiated, however long the term is, or in some cases, the land contract is only for, it's spread out, the payments are spread out as if it's 30 years, but then you're actually saying, you pay me for the next 2 years on this 30-year note, but then you've got to go refinance it. So in other words, the note matures. So that means that would have to be refinanced by the buyer or paid off entirely by the buyer. So think about that. It's almost like the bank is, the seller is handing the buyer a mortgage. So it's basically the seller is acting as the bank. So during the period of the contract, again, the buyer's going to make these monthly installment payments. I say monthly, could be any other period, but I've only really seen these monthly because that's how we normally pay our mortgages. The buyer's going to make their monthly payments, their installment payments on the purchase price. They've got possession of the property. They have equitable title to the property. Now, in any of these scenarios, land contract, lease purchase, or lease option, a lot of times if you are a traditional seller, you have a mortgage on the property with your bank. Your bank is not going to like that you are trying to sell this property and act as a bank or have some sort of what they would call a cloud on the title, because the bank that you have, you're as the seller, your bank is assuming that they can always foreclose on the property and take it back, and you are the only person involved, that there's not these other parties that have some sort of equitable title or that are going to be there beyond the lease. So you've got to, as a seller, know that you're going to hold the legal title. You're still going to be liable to your bank if you've got any what we call underlying mortgages or loans. And quite frankly, your bank probably doesn't want to sell you to sell this property on a land contract. So you're going to want to always read your mortgage note to see if they are wanting or able to allowing you to do some sort of land contract on the property. If you do a land contract on the property with a buyer, you may want to consider and talk to your legal counsel whether that buyer should be allowed to record this note. So land contract, you are going to be, as a buyer, making installment payments on the purchase price. You have possession. You have equitable title to the property. As a seller, you still hold the legal title. You're not giving away that legal title, and you are still liable to your bank for anything you owe on the property. So when the buyer of your property completes the required payments, that's either that they've paid all the payments, so in other words, over the course of this loan, they paid them all. The loan is paid off completely because they've come and they've refinanced it, or that they have come in with cash and paid it off entirely. When the buyer completes the required payments, the seller has to then deliver valid title by way of a deed. So in other words, contract for deed. You're going to sign the contract now. You'll get the deed as the buyer when you've paid off this note. And at that point, obviously, if there was any sort of encumbrance on the property, so in other words, an existing mortgage or lien or debt on the seller would pay that off with the proceeds, and then they would give you, as the buyer, a deed. So a land contract is best drawn up by an attorney, not a realtor or clients. If you Google online, you can find all different kinds of forms, but they don't always hold up in court. Have an attorney draw up a land contract. A lease, there's standard leases out for most every MLS and provinciality that I know of. You could do an addendum to those. You could contact legal counsel. We obviously recommend always that you talk, if you are an agent, with your managing broker. If you are a buyer or seller, a client, talk to your realtor and potentially your legal counsel about this. So 3 different types of property transfers, property contracts that you can do in creative financing. Benefits to each. Options out there beyond simply getting a mortgage loan. Think about this. So any questions, we are happy to answer them at any point. Just message us directly. And I'd like to thank everyone for coming to the webinar. And if there's any further questions down the road, just message us anything that you need. We will talk to you guys very soon.